California's hidden crisis, the great insurance exodus. Once, the California dream meant freedom, success, and sunshine. It meant opportunity, the open road, the ocean breeze, and a home to call your own. But today, that dream is quietly shifting, not in a sudden crash, but in a slow unraveling. For decades, California symbolized everything bright about America: prosperity, growth, and a promise that hard work would always pay off. But in 2025, the promise feels uncertain. Behind the luxury real estate listings and glossy headlines, a quieter story is unfolding, one about risk, regulation, and retreat. It begins with fire. Every summer, flames sweep across the state, destroying homes, forests, and entire communities. Insurance companies pay billions in claims, and now they're saying, enough. In the last 2 years alone, major insurers like State Farm and Allstate have pulled back from California's market. They say the numbers no longer work. Wildfire risks keep rising. Reinsurance, that's the insurance companies buy for themselves, has become too expensive. And state regulations prevent them from raising premiums fast enough to cover the losses. What began as a few quiet announcements is now a full-scale retreat, an insurance exodus. For homeowners, this means renewal letters that never come, policies canceled, new quotes that are triple the cost. Some families are paying more for insurance than for their property taxes. The ripple effects are spreading through every part of California's housing market. Buyers hesitate, sellers panic, agents struggle to close deals. And in the background, the dream of homeownership grows dimmer. So what's really happening? Why are homes being dropped? Why are insurers leaving a state with one of the world's largest economies? And most importantly, what does this mean for California's future? In this investigation, we'll explore the roots of this crisis, from the billion-dollar fires to the fine print of Proposition 103, the law that reshaped California's insurance system decades ago. We'll examine how climate change, regulation, and economic pressure collided to create a market on the edge. Because this story isn't just about numbers, it's about the people living inside them, families losing coverage, communities priced out, and an entire state trying to hold together a promise that once seemed unbreakable. This is California reality, and this is the Great Insurance Exodus: Why California Homes Are Being Dropped. The story of California's insurance crisis begins with risk. Not just the kind you see, but the kind you calculate. Insurance is a game of numbers, of odds, probabilities, and models that predict the unpredictable. And lately, California's odds don't look good. Over the past decade, wildfires have become larger, hotter, and far more destructive. The top 10 biggest fires in California history have all happened since 2017. Together, they've burned over 10 million acres. Every fire means billions in damage, homes destroyed, claims paid, lives disrupted. In 2018 alone, insurance companies in California lost nearly $13 billion to wildfires. By 2023, their executives were saying what no one wanted to hear: we can't afford to stay. Insurers aren't just battling nature, they're battling math. Reinsurance, the safety net that helps insurance companies share risk, has skyrocketed in price. In some cases, it's up 40% since 2020. So now, a company like State Farm faces a dilemma. They can't raise premiums fast enough to match the rising cost of risk. And the reason lies deep within California law. Back in 1988, voters passed Proposition 103, a law designed to protect consumers from sudden price hikes. It rolled back rates by 20% and made California's insurance commissioner an elected official. On paper, it was a victory for fairness. But in today's climate, it's become a chokehold. Under Proposition 103, insurance companies must file lengthy, technical applications, sometimes over 10,000 pages long, just to adjust their rates. That process can take months or even years. And every day of delay costs millions. California's system is designed to keep rates reasonable. But the world outside the paperwork is changing faster than regulators can react. When risk changes overnight, but prices can't, the system cracks. In 2023, when wildfires destroyed over 1,000 homes in Northern California, insurers filed for modest rate increases. Months later, approval still hadn't come through. Executives called it unsustainable, and one by one they began to exit. State Farm stopped accepting new homeowner policies. Allstate followed. Farmers capped their new coverage. And that's when California entered a new phase. What analysts now call the Great Insurance Exodus. But here's the paradox. Even as insurance disappears, home prices stay high. Why? Because California's supply of homes hasn't kept up with demand for decades. Regulations don't just affect insurance, they also affect construction. Every new home project faces years of environmental review, legal challenges, and zoning restrictions. So even as buyers leave risky areas, there aren't enough safe alternatives. For insurers, it's not just about wildfire damage, it's about policy failure. They're squeezed between climate risk and government control. Too much fire, too little flexibility. Even California's insurance commissioner admitted earlier this year. By law, they don't have to be here. When regulation pushes too far, companies walk away. The result is a fragile market where the few insurers that remain are overwhelmed. And millions of homeowners are left with a single option, the state-backed FAIR Plan. The FAIR Plan was designed as a last resort, but now it's becoming the only resort. It offers limited coverage, high costs, and long delays. In some regions, premiums have jumped to $10,000 a year. And even with that, the FAIR Plan itself is under strain. Its president warned in early 2024 that one major wildfire could bankrupt the fund. So what happens when even the backup system breaks? That's the question at the heart of California's new reality. A state once known for innovation, now struggling to insure its own homes. The insurance exodus has done more than raise prices. It's reshaping the way Californians buy and sell homes. Behind every headline about corporate withdrawals are thousands of families caught in limbo. For many homeowners, insurance is no longer a routine expense. It's a barrier to stability. Premiums that once cost a few thousand a year now stretch past 10. Some families have to choose between coverage and renovation, between protection and peace of mind. When insurance costs spike, mortgage lenders take notice. Banks won't finalize a loan without proof of coverage. If a policy is unavailable or too expensive, the entire sale collapses. It's happening every day. Buyers pulling out, agents scrambling to find last-minute insurers, and sellers watching their offers expire. Data shows that California home insurance rates rose 25% between 2021 and 2024. But for many fire-prone zip codes, the increase is double that. And it's not just the cost, it's the uncertainty. Lenders say deals can stall for weeks while buyers hunt for coverage. Appraisers downgrade values if a property is near a fire zone, and some neighborhoods are quietly falling off buyers' maps altogether. Real estate agents call it the silent freeze. Listings stay up longer. Showings draw fewer people. And every conversation ends the same way. What's the insurance situation? In regions like Sonoma and Plumas County, inquiries have dropped sharply. Buyers who once saw these areas as affordable alternatives are now priced out by risk alone. But California's story is not uniform. While some markets cool, others heat up. In the Bay Area, high-income buyers barely flinch. Tech professionals and investors absorb the cost of coverage as just another line item. For them, the dream is still alive. But for middle-income families, the door is closing. Thousands are leaving for Nevada, Arizona, and Texas, places where insurance is cheap and approval is fast. Every departure means another empty home, another lost taxpayer, another dent in California's economy. Agents say their jobs now require skills they never needed before: policy navigation, risk assessment, and constant updates on which companies still write plans. It's no longer just selling a home, it's explaining how to keep one insured. And for buyers who finally find coverage, there's a new problem: it may not last. Policies are reevaluated yearly. One severe fire season can trigger mass non-renewals overnight. For many families, it feels like a game of musical chairs, and the music is getting faster. Economists warn that these insurance pressures could create a new kind of housing inequality. Not just between rich and poor, but between insurable and uninsurable. Two different Californias are emerging. One protected by wealth and resources, the other left exposed to risk. And it's not only individual homeowners feeling the strain. Local governments rely on property tax revenues, and when insurance becomes unavailable, property values drop. Counties from Shasta to Santa Cruz are reporting budget gaps as home assessments decline. It's a slow-motion economic shock, and like all California crises, it's uneven. Still, there are signs of adaptation. A few major insurers, Mercury, USAA, CSAA, have committed to stay and expand their presence in the state. Some specialize in lower-risk zones. Others are experimenting with fire-resistant home discounts and AI-based risk mapping. Innovation is slow, but it's starting, a sign that California might still find a way to insure its dreams. As the sun rises over California, a new question lingers in the air. What comes next? A state built on resilience now stands at a crossroads, between regulation and risk, between fear and reform. For decades, California's insurance rules were written to protect consumers from greed. But today, those same laws are protecting no one from collapse. At the center of the debate is Proposition 103, a 1988 reform that gave the insurance commissioner the power to approve or reject rate changes. It worked for a time. Rates stayed low, profits stayed modest, and coverage was widespread. But in 2025, the world looks different. Fires are larger, rebuilding is costlier, and reinsurance, the backbone of the global safety net, now costs more than ever before. So insurers face a cruel equation. They can't raise prices fast enough to cover their risk, and they can't afford to stay. In 2024, Commissioner Lara admitted what many already feared. By law, they don't have to be here. And one by one, they left. Now state leaders are trying to reverse the damage. The newest proposal would modernize rate approvals, letting insurers factor in wildfire models and future catastrophe data instead of relying on outdated 20-year averages. That could mean faster adjustments and perhaps a way back for companies that left. But reform alone won't solve the deeper problem, fire. California's forests are overgrown and tinder dry. Years of drought and delayed maintenance have turned millions of acres into fuel. Experts call it fuel reduction. Prescribed burning and forest thinning meant to prevent megafires before they start. Yet funding remains inconsistent, slowed by environmental lawsuits and local opposition. Without prevention, every reform is temporary. Insurance will keep chasing catastrophe instead of outpacing it. Still, there is reason for cautious hope. 5 major insurers, Mercury, CSAA, USAA, Pacific Specialty, and California Casualty, have pledged to stay and grow in the state. They're betting that technology, risk-based pricing, and cooperation with regulators can rebuild trust. Some are testing AI models that reward homeowners who harden their properties, clearing defensible space, upgrading roofs using fire-resistant materials. For families willing to adapt, it could mean real savings and a lifeline to stay insured. Developers, too, are adapting, building smarter, smaller, and safer. In regions like Fresno and Riverside, builders are experimenting with fire-resistant materials and cluster housing that shares defensible space. If the model works, it could redefine what it means to live in California's high-risk zones. For now, though, the gap remains wide. Millions still depend on the fragile FAIR Plan, a program that was never designed to carry an entire state. Its president recently warned, one catastrophic event could break the system. If that happens, California could face a true affordability crisis, not just for homes, but for safety itself. Still, this is California, a place that has survived quakes, fires, droughts, and recessions, and somehow keeps moving forward. The story of this state has never been about perfection. It's about persistence. Every time disaster strikes, Californians rebuild. And maybe this time they'll rebuild smarter. with policies that balance protection and freedom. Because the California dream isn't gone. It's just being rewritten. One policy, one home, one family at a time. This has been California Reality. If this investigation helped you see California a little more clearly, subscribe for more quiet truths and real-world stories about the Golden State. Every week we uncover the hidden side of California, from housing and cost of living to the people still trying to hold on. Thank you for watching. And remember, even in the middle of crisis, there's always a way forward.